Thanks for joining us. I'm Marlon Bowling with a look at our ag commodity trade. Well, we are in the middle of the annual USDA Ag Outlook Conference that's been going on in Arlington, Virginia, outside of Washington. And so we have been watching with great detail about what the numbers are coming out of that conference. Some of those numbers are related to what's going on with our acreage. And they did come out with some numbers this morning. And the corn acreage they came out with was 94 million acres here in 2020. That's what they expect to see. That would be a 5% jump from the acreage we had a year ago. And the soybean acreage, it was a big jump, but it was exactly where the trade thought it would be. They expected a number around 85 million, and that's exactly what we got for this year. So still a big jump, no matter how you slice or dice that. And the market in general has been kind of on the defensive here today. The corn market is a little bit weaker here. We have it now trading on the March a penny lower at 379.5, and we have July down 1 3/4. And new crop December down a penny and a half at 389.25. Now it dropped down below that 390 mark, and it just can't seem to muster up enough energy to get back to it again. And let's take a look at our soybean market. Soybeans under pressure yet. We have the March down a penny and a quarter, while the May is down 2, and the September down 3 cents. So a little more pressure as you go further out in the trading calendar. Looking at the wheat market right now in Chicago, you have March 5.5 lower at 559 3/4 as they continue to take back what they had gained earlier this week. The Kansas City market also lower. We're down 6 1/4 at 473.5. And speaking of the Kansas City area, I want to bring in Brian Hoops of Midwest Market Solutions. He's there from Missouri, in Springfield, Missouri, to be exact. And we have a lot of weakness in this wheat market after we had that big run up at midweek. And you and I had talked about this before. A lot of folks were wondering the day that that happened. Remember how we had Chicago wheat over 20 cents higher? And there was quite a bit of talk around the trading circles about, well, gee, did they overdo it? Did they overrun their headlights today? Is this proving to be true or not?
Yeah, good morning, Marlon. I think that is partially true. It was a rally that really wasn't supported by longer-term fundamentals. It was a very active fund market, participants in that day, and a lot of stops were triggered. Really drove that market much higher than what it was fundamentally justified. And today we're taking back a little bit of those gains. We did the same thing yesterday in the trade, but the big thing we've seen as far as spread trades as Chicago gaining against Kansas City, and that I think is going to continue until we get some new crop harvest done. So that could be several months away, but Chicago's likely keep that premium above the Kansas City market and continue to gain against Kansas City and widen out that spread.
It's a real uphill battle with that strength in the U.S. dollar right now, isn't it?
Yeah, it's going to be. You have the dollar hitting new highs, and that does not bode well for any commodity as far as our exports go, particularly the wheat market, which is really susceptible to strength in the dollar giving way to exports. But we've managed to rally the wheat market since August, September of last year when we bottomed. While the dollar's been rallying, but this may be the kind of right ahead of harvest here, kind of a market that is unable to reach new highs once again because our exports are starting to slow down.
Okay, Brian, we'll come back here in a moment and we'll pick apart this livestock trade. We're going to take a look at cattle and hogs after these messages. Maybe some surprises in there, so stay tuned. We'll be right back. Well, we're talking with Brian Hoops right now. He's with Midwest Market Solutions, and I want to take a look at some numbers that have come out as a result of a survey done by the Wall Street Journal about the upcoming cattle on feed report. That will be coming out tomorrow after the markets close up for the day. And if we take a look at what they expect to see for the on-feed number, the average trade guess hovers around 102.3% of a year ago, and the placements at 101.5% of a year ago. In other words, a 1.5% increase over last year's level at this time. And then the marketing's at 101% of a year ago. So they're looking for higher numbers across the board. Brian, how do you feel about the situation with those numbers stacking up the way they are this particular time around?
I think that's what's pressuring the cattle market here this morning. The cash trade that we saw yesterday should be a supporting feature for this week, but we're seeing a lot of selling pressure coming from fund traders this morning in the April contract, and most likely they're looking ahead of that support or that survey with on-feed supplies 2.5% larger than a year ago, placements 1.5% more than a year ago. And thinking that this may pressure the market just in the near term here, but I know we're thinking the cash market's getting close to finding some sort of a bottom in the next couple of weeks. Cutout values, in the same way, should be trying to find a bottom here, and that will limit the downside, especially for those summer months as they are approaching the 110 area for June and August. That should offer an opportunity where producers may start to take some of those hedge positions off.
Yeah, those cutout values were down sharply yesterday. In fact, on the choice cuts yesterday, they were down 56 cents on the beef side. And then you look at the select cuts yesterday, and they were down well over $1. So the spread really widened out yesterday. In fact, they were almost $2 lower on the selects. Now, let's go back to our futures, and we'll get you updated on our current quotes in Chicago. So we'll start with the live cattle board here. And we have the April contract 75 lower at 120.05, pretty close to the low of the day here. We have June down 63, now down 50 at 111.80. On the feeder cattle market, well, in the feeders, we have the March now trending 38 lower at 140.40. We have April down 68. And the biggest drop is in that May contract, and it's down 90. Well, now the August has the biggest drop. It's down 93 at 150.85. On the lean hog trade, let's switch over there, and this has had quite a bit of volatility this week. Right now, April lean hogs down 75. We're at 66.83, and the May contract dropping 40 cents at 74.90. But all eyes on June, and they're really pounding on the June contract today, down $1.05. We're now at 82.13, and that is by far the biggest drop of all the contracts on the lean hogs so far today. So, Brian, thanks for helping us navigate the waters on the livestock trade. Appreciate it. Brian Hoops of Midwest Market Solutions. He's in Springfield, Missouri. That's the latest activity on the livestock.
You look at the livestock market, it has been so hard to have a steady run just over the past couple months. It's almost like we just don't look for it anymore.
The hog market had a huge decline. It's trying to get its footing. Interesting chart patterns, though.
Yeah.
It's looking a little better on the charts long term.
Okay.
Long term.
We'll see. Thank you, Marlon.